Hello, my name is Jason Attew. I'm the president and CEO of Osisko Gold Royalties. It's important, I think, people understand or appreciate Osisko Gold Royalties is a fairly relatively new company. We just celebrated its 10th anniversary, and it was really backed around our foundational asset, the 5% royalty or NSR, the Canadian Malartic, for which that was the first producing asset just 10 years ago. And if people know the Canadian Malartic operated by Agnico Eagle, it is absolutely a workhorse. It still represents approximately 37.5% of our 2024 cash flow, 30%, 25 to 30% of our NAV, and the single royalty is widely acknowledged as the best gold royalty in our sector by all our peers. Since over the last 10 years, obviously we've added more assets, so we have over 185 assets in the portfolio, and 21 of them are producing. But we are a precious metal royalty company for exposure around gold, silver, and a few other commodities. Exceptionally high quality in very good jurisdictions.
Jason, good to see you. It was, I think, October 2021 when I last saw you. So a lot has changed in the world, and a lot has changed with you guys for sure. Look, we talked back then about business models, strategies, etc. And you've been evolving yours. So can you talk me through the change and the different look that you've got?
Great question, Matt. So firstly, for context, I've now been the CEO for about 16 months. And so maybe I'll take you through a year or 16-month in review, if you will. When I joined, I recognized that there were 4 discounting factors that was really impinging on the company's true fundamental value, market cap value, its growth opportunities, and as I said, ultimately its stock price. The first being the business model. When it was founded, again, 10 years ago, Osisko Gold Royalties, in an attempt to differentiate itself, embarked on what is known as a generator model or an incubator model by buying, developing mining assets and attempting to create value by advancing them through the development cycle, for which obviously the end game was to either sell or operate these assets, at the same time retaining or putting on royalties on streams on those assets. Admittedly, it was a very interesting concept at the time. However, we have empirical data and evidence that this led to led to destruction of shareholder value. It's a very different skill set involved in advancing assets through the development curve. It's a very different environment around permits, take a lot longer, construction timelines, and capital required through an inflation environment is much more challenged than it was even when they started 10 years ago. So our business model is all we do right now is we're a pure play royalty and streaming company. All we do is we're a provider of capital in the form of royalties, streams, economic interests on high quality assets to management teams who we believe have exceptional technical acumen in the best jurisdictions. And so again, we are a pure play a pure play royalty and streaming company now. In terms of the second discounting mechanism, was Osisko Gold Royalties did have a pretty poor governance record. And so we've improved this significantly by the elimination of an executive chair. We've removed, over the course of the last 15 months, all the related party transactions and went through a painstaking process to untether ourselves from the rest of the Osisko group of companies. There are a number of them. We are 100% independent with zero influence from these historic companies and arguably the personalities who ran them. The third discounting mechanism was the debt situation or the debt load the company had when I first joined. So this time, or when I first joined, or now our net debt was, and this is US dollars, over kind of $250 million. Today, we exited 2024 in a net debt position of 35. Effectively, we're in a net cash today because obviously we'd be making very good cash flow for the past almost 3 months. And it really was this improved balance sheet which became the enabler for us to execute on accretive transactions. We also do have, this is CAD, $750 million in liquidity through a revolver facility to go out and source transactions that will move the needle for our stakeholders within a 5-year outlook. And so I would say, lastly, we know that we're going to be judged by the transactions that we do under this simplified model. We actually did execute on 3 transactions last year. The 3 transactions are, again, 2 of the 3 fit very, very well to our brand in that they're near cash flowing or cash flowing. The first one being is we topped up our stream with Osisko on their asset when they consolidated the remainder from their Japanese interest. So we now have 100% of the silver coming out of Gibraltar asset in British Columbia. We also made a very interesting asset acquisition or royalty acquisition, as a gross royalty on an asset in Western Australia called Dalgaranga, which actually is quite topical these days, because Ramelius Resources actually has agreed to a transaction just last week with the operating company called Spartan Resources. So we have a 1.8% royalty on that asset. And it's interesting because during the conference call, in terms of our numbers, we weren't expecting that asset to be cash flowing and us generating the royalty until about 18 months from now, 18 to 24 months. And the CEO of Spartan Resources effectively said that they're expecting, or they could actually be in gold by the end of 2025, the end of this year. So another one that fits with our geological prospectivity profile, certainly a geopolitical risk. We really, really do think that one of the big differentiating factors for Osisko Gold Royalties is about 80% of our net asset value are in what we define as tier 1 jurisdictions, being that of Canada, the US, and Australia. And obviously us picking up an Australian asset last year was very, very good. We always get questions about, we are a mid-tier royalty company. We always get questions about how do we compete and how much of the flow are you in. So for context, what I'd like to say is we certainly are involved in every single process that gets printed, even the bigger transactions from Franco, Wheaton, and they were quite active last year as well. But I always like to do very good look-back analyses. And last year in 2024, there was approximately $3 billion of royalty and streaming transactions concluded. Our share of that was approximately $300 million in terms of the 3 transactions I mentioned, the last one being Cascabel, an asset that we did a syndicated transaction with Franco for a world-class asset in Ecuador. But I think the point is 300 million on 3 billion of transactions, roughly 10%. The other piece of context that you should have is, again, Osisko Gold Royalties is a mid-tier. We're approximately $4 billion US in terms of market capitalization, over about a $75 to $80 billion in aggregate market capitalization of all the companies out there, so roughly 5%. And so for 5% of the market capitalization, we're actually getting 10% of the flow of our deals. That certainly would suggest that we're punching well above our weight. We're involved in all the flow, as well as we're trying to get a number of transactions, high quality transactions, 1 or 2 this year, through bilateral discussions. So it's a great business model. And again, we're punching above our weight in terms of the acquisition or the deal flow. And if you actually go back and look at 2023, it would be roughly the same metrics of us getting about 10%, 10 to 12% of the overall deal volume out there.
Okay, so lots to take on there, and I made a few notes. So if you don't mind, I kind of rip through those systematically. Look, all companies need to talk about a growth story, and you've talked to that with some of the information you've given us there. But moving out of the kind of the development arena makes a lot of sense. There's been some horrific value destruction there for the last couple of years. I can see why you'd want to do that. In fact, quite frankly, the majors do that too. Sometimes stay well away from that. But what we're seeing at the moment is a lot of kind of mergers of equals, right? So no new answers, just mergers of equals. Big producers coming together. We're seeing the big boys, picking, using the cash that they're producing, this high-priced gold environment to pick up the better projects. Royalties, an environment like this, is there a role for royalties when there's so much cash sloshing around from the majors?
So, look, it's a really good question, especially given the fact that obviously the commodities that underpin these equities or underpin the strategies of boards has been quite elevated. And certainly we had some great appreciation in gold and silver in particular over 2024. What I can tell you in terms of the royalty and streaming sector, though, is first of all, in terms of the finance environment, it is actually not as robust as it was 10 years ago for development assets. And these are more so not the big groups, not the seniors, anything that's got, tens of billions of dollars of market cap, but anything below that. When they go through their financing process, given the fact that, again, it's quite expensive from an equity perspective, there's still a significant dislocation in terms of equity price and the commodity price that we're seeing and appreciating right now. That again, there's reluctance to fund these growth projects or fund their growth through equity in the first instance. That might change certainly over time. But secondly, and I think more importantly, is there's been a significant retrenchment around the traditional project finance environment. Most of the banks, the global banks, have exited that arena, and therefore, when you see projects that are looking for funding or financing, there's always a royalty or streaming aspect to it. They might not always choose in terms of the capital structure or the capital components of funding their development or growth. But certainly, in terms of their process, they do reach out to all of us. They ask us to put bids forward because it is a very cheap cost of capital for them vis-a-vis, again, what you're going to get from the dilution of equity and even what you're going to get from the project finance lenders, because they come in two forms. There's still a couple big banks that do it, but there's also the private debt groups. And those private debt groups, and the cost of capital that they're looking at, their returns are significantly more than what we could provide in terms of a royalty of stream on assets. The last thing that I would mention, Matt, is in terms of our deal pipeline. It's not just on the gold and the silver side. As you can appreciate, it is tremendously advantageous for both parties around big copper projects or big base metal projects that have a byproduct such as silver or gold that, again, is not that critically important for these companies that are trying to grow out, again, around the energy transition theme, grow out their production profiles and provide growth to their shareholders. As we know, copper in particular and some of the other base metals didn't have a strong year in 2024 vis-a-vis, again, gold and silver. And so I would say that approximately half of our pipeline is in fact financing the growth plans and objectives of base metal companies versus pure gold companies. So there's still very much an appetite to do that because it does make a lot of sense, just given the multiple arbitrage as to where royalty companies versus pure base metals companies are trading and what we can provide in terms of capital for growth of a big, for example, porphyry in South America.
Yeah, and I take what you say with regards to this very different financing environment when equities are so far off of what used to be the kind of the average 4 ounces in the ground. Troilus recently put together kind of quite interesting syndicate of financiers from out of Germany, out of Europe, to using their copper component of their gold project, so which may actually pay for the bill. Now, people having to be creative, and models are changing. So I appreciate that. Just this is about you. So when I look at people like Franco-Nevada, Wheaton, and Royal Gold, etc. I mean, do you think they're following the same model as you? Is there any differentiation between the four of you?
So, great question. Again, as I said, we're in every single one of the processes that Franco, Wheaton, and Royal are in. There's not a single transaction that we saw printed that we weren't either aware of or we weren't involved in. Obviously, with the bigger companies, they have a lower cost of capital. So if they really do want something, it's going to be incredibly challenging for Osisko Gold Royalties to compete just on a price perspective. All that said, and again, the proof will be in the pudding. What we do, and I think we do very, very well, is we can get very creative on structure, meaning that, again, we're not going to sacrifice our returns, but if there's certain nuances from a counterparty, for example, understanding their cash flow profile and adopting a royalty that would step down during periods for which there's a capital intensive period, and then when they're in harvest mode, that would get ratcheted back or maybe no more normalized. That's certainly something that we do without sacrificing returns. What we've heard from the counterparties that we're talking about is the Francos and the Wheatons and the Royals are less, let's just say, flexible around structure. And so that could be certainly one advantage. But certainly, again, it's a competitive sector. There's no question about it. As I said, 10% of the overall flow is about right for our company. We also, as I said at the outset, look to do club deals and syndicate. We did a very successful transaction with Franco-Nevada last June, July, on an asset that everyone would applaud and acknowledge as a world-class copper porphyry. Again, they've got shareholders such as BHP on the register. This is SoGold that I'm talking about. And so we'll do those type of transactions, looking to do syndicated transactions with the bigger groups, but it does require a certain set of circumstances. With Cascabel, for example, both Franco and ourselves had an historic royalty there. We've been to the site multiple times. We understood the challenges and the opportunities in Ecuador, and so it was something that was very logical to come together and work together. I wouldn't say that's commonplace, but again, from my seat, if we can do more club type syndicated deals around larger transactions, that just, I think, will be very beneficial to our shareholders go forward.
Okay. I guess the brokers do it. Why shouldn't you? Just let's talk about the process that you go through, because I guess when I look at this sector, I look to, like, you've had a good year. You're talking about 10% of share of market. Where in good times, you would explain why perhaps royalty still has a role to play. But this fear of, I think you'd agree that trying to sustain that going forward would be the secret sauce here. If you can do that and obviously maintain that or grow that share, what do you look for? What when you what sort of filters do you apply? I'm talking in terms of your expectation around payback periods, because sometimes these things take a little bit longer, as you said at the beginning, to actually get into production, or things go wrong, or jurisdictions do play up, or the operator perhaps takes a misstep, etc. How do you kind of factor that into your filtering?
So again, from a filtering perspective, we have a number of filters. Firstly, maybe I'll talk about, and it has changed since I arrived. So our focus, as I stated before, is on cash flowing opportunities or near cash flowing opportunities. So we really don't, unless it's an exceptional opportunity, looking at anything in the exploration state. Because, as I said, we've got a long tail of optionality with 185 assets in the portfolio. Unless something just really, it starts in, or we've got a few geologists, starts pounding the table, and that's not really our focus. And so near cash flowing means within our 5-year outlook. We did put on February 19th a 5-year outlook that shows all bought and paid for, so no contingent capital associated with it. Approximately 40% growth from our midpoint of 2025 guidance. So this is, again, if we did nothing, shareholders could expect 40 to 50% top line growth over the next 5 years. So we're in a situation where we can afford to be very disciplined, firstly, and secondly, again, go after deals that will move the needle for us. And what I mean by that is our filter is anywhere between US 50 million to 500 million. So not too big, not too small. We feel we're in terms of our company, we're in this Goldilocks zone, because if you do those transactions, as I mentioned, 50 to 500, it really can move the needle, as long as it's accretive deals and in terms of us getting a return back for our shareholders. You mentioned what the payback period is. Our methodology, we use two types of methodologies. And before I get to that, the other filters are, really good high quality jurisdictions, because as I said, that is one of our differentiating factors. We want to continue to add assets in Canada, US, and Australia, and we'll continue, and we've got lots of opportunities to do that. But getting back to the financial returns, firstly, we have to do deals that are above our hurdle rate. And our hurdle rate is basically our WACC, which is very much informed by our cost of debt, because like most royalty companies, we draw down on our facility, for which then we pay back with cash flow from our operations. And it is on a variable rate, but right now our cost of our facility is anywhere between 5 and 5.5%. So we need a spread over that. So for us to actually have accretion to our shareholders, that could be, again, depending on the other risk aspects, technical risk, sometimes geopolitical risk. We'll apply various aspects to it. For example, if we're going to be doing a deal in Quebec that we very well know with very good operators, that spread might look like 100 to 150 basis points versus a development opportunity in Peru, so it would probably be double of that. And so that's how we think of things, because at the end of the day, we're effectively risk managers on behalf of our shareholders' capital.
Okay, so in terms of, like, you're talking about lots of the kind of risk mitigation in terms of change the strategy, focusing on the right sorts of companies with a kind of near-term revenue profile. I think last year you talked about sort of 81,000 gold equivalent ounces, which is great. But with a near term at $4 billion US dollar valuation, what can we expect to sort of see coming through? Not in a 5-year time frame, but more in the sort of 12 to 24 month time frame.
In terms of acquisitions, do you mean?
Well, I mean, in terms of actual revenue, driving that revenue number.
Well, so obviously, and again, I'll talk about 2024 because it's easier to, but obviously in this commodity environment, and now we're through $3,000 gold. Last year on the 81,000 that you mentioned, and we were at $3,000 gold, our revenues was US dollars. We've actually moved from, so that's another important point, we've actually moved from CAD to US dollar from a presentation perspective. So historically it was all in CAD. In 2025 we're now presenting in terms of US dollars to make it much more comparable, firstly, but also US is the dominant currency around gold and silver and precious metals. But we, from a revenue perspective, last year we generated approximately 192 million US, for which, again, there's not a lot of overhead, there's not a lot of G&A in these companies, as you can appreciate. We generated close to 160 million, around 160 million of operating cash flow last year. The expectation is for this year, if the commodity prices continue where they're at, and absent anything that happens within, obviously, capital structure, we are expecting to generate about 20 to 30% above that level of 160 million of operating cash flow in 2025. And obviously, if the commodities still can continue to appreciate, again, it's going to be very beneficial for shareholders. The last thing I'd say on that, Matt, is in terms of our business, because we've got the Canadian Malartic, which does represent a big chunky part of our business, and it's a royalty, our cash margins approximately 97%. So every dollar that we see in appreciation of the gold or silver price, gold in particular, that goes right down to our bottom line, because we are very, very, very royalty centric versus some of our peers that have a number of streams, and there's obviously transfer prices associated with that. So we're much more leveraged to the appreciation in gold in particular because of how our portfolio is set up.
Right. Okay. So Malartic, fine. You mentioned, I think, Tocantinzinho earlier, and obviously Cardinal, Mantos, and CSA, etc., etc. We'll start to add to that bottom line. But again, coming back to that point in terms of either issuing guidance or if you could give some sense of what the returns are going to look like in the next sort of couple of years.
Sure.
Because, and then what are you going to do with that money? Because obviously you're sitting on what I think you mentioned. So was it just over 600 million, something like that, US in terms of liquidity? Is that right?
So that's our available liquidity through our facility we are sitting on right now, where we ended 2024 with 59 million of cash and net debt of 35 million, because the company did pay down close to 85 million against its revolver throughout 2024.
Got it.
But to answer the question, Feb 19th, we put out our 2025 guidance, which essentially talks about between 80 and 88,000 gold equivalent ounces production. That at a midpoint is roughly 4 to 5% an improvement over 2024. But I think which is modest, I would say, growth, but where the real growth starts to kick in is over our 5-year period. And as I said, we're going to be going from, what we closed last year, 81,000 gold equivalent ounces, to 110 to 125 over the 5-year period. And I will tell you, we're very, very confident in that, because the assets that are driving that growth, 50% of them are assets that are already in production. The two main ones being Mantos Blancos, which Capstone Copper operates, again, driving a lot of that growth. The other one being Alamos's Island Gold. Island Gold is quite a unique asset for us, because after the Alamos Group bought Argonaut last year, they are no longer mill constrained, because Argonaut had a mill called Magino Mill, which allows them to push a lot more throughput in. They've got studies that will be coming out over the next 12 months or so that actually will demonstrate an increased throughput and increased grade, because of the way the deposit works. As they move through and get deeper, the grade actually increases significantly. And the most interesting part is, because of the way royalty boundaries are set up, as they move through and increase throughput and grade, our royalty goes from 1.38% to close to 3%. So again, there's a triple multiple effect here that, again, will be driving that growth into 2029. And those are assets that are already in production. The two real development assets that will also assist, and that will make up another 50% of that growth, are assets that we feel are very comfortable in that they've got large multi-asset sponsors or owners behind them. The first one being Windfall in Quebec. And so Windfall, for your audience, if you weren't aware, was consolidated last year. Goldfields picked up the other 50% from Osisko Mining. Again, multi-asset company that's obviously got financial wherewithal to bring that into production. A very high quality, high grade asset in Quebec. So very confident we're going to start receiving our cash flow or royalty payments over the next 5 years with respect to that asset. And the other one is an asset in Arizona called Hermosa Taylor. Again, South 32 for your audience, a multi-billion-dollar base metal diversified company. And they've actually got the Fast 41 permitting acceleration in the US. And so we've got a nice royalty there. So it's not assets or any of the assets in our growth profile that require any sort of subsequent financing. There are no single assets in this growth. It's really underpinned by what we believe is high integrity assets with very good operators that will provide that, as I said, for approximately 40% growth if you take midpoint to midpoint over the next 5 years.
Right. Okay. Well, let's get on to return on capital invested. Okay, because I think when gold goes from $2,000 or just under to $3,000, it's quite easy to look brilliant. It covers a multitude of sins, is a phrase I use, right? But I'm more interested in one. You said it from the outset, sort of the realization and analysis of perhaps focusing on development companies is not the wisest thing to do. So you change that. But what are the other things that you look at when you're actually analyzing the return on capital on investment? Because I think that's so important, because you've kind of got this drawdown facility, you've got that costs you money. You don't want that to drag on for too long before the revenue starts flowing in. You want to make sure that the companies are able to hit those sort of numbers that you think or thought originally that they were going to hit, etc. So how do you analyze all of that?
So we do use the traditional metrics you mentioned in terms of the ROIC, return on invested capital. For sure, we do that. What we also do use, because some of the assets that, for example, the Cascabel asset, this is a multi-generational asset. You expect that once it gets up and producing 50, 60, even 70 years of operations there, and they've got another porphyry right next door, so it could even be longer than that. So the metric that we like to use, we do use, as I said, IRRs. We also do use the return on invested capital, but one that we do look at, in all our circumstances, is a multiple on invested capital. And so that multiple will actually will vary depending on, again, the asset's longevity and life. But we do, as I said, the primary method that we're looking at is to make sure that we're providing an accretive return for our shareholders. It's got to meet a certain hurdle. That, as I said, is really driven by the IRR. We are not going to be doing deals, which we've seen some of our peers do at 1-2% returns, IRR. And because we've got the portfolio that I mentioned, we've got all that growth, we can afford to do that because it's just value destructive, and it's really then a bet on the commodity price and or the operator being very, very efficient and getting the most out of assets, which, I've been in the business. It's my 30th year in mining, and it's a very tough business. PowerPoint mining just does not work. And so you've got to really be careful and again, understand the various assets here. And so that's our financial framework of how we look at making investments.
Okay. Some of my best gains have been from PowerPoint and Excel spreadsheet. Right. But again, so I'm kind of intrigued about how you can protect yourself and how you stop having to take the hit. So in terms of like sliding scale royalties or caps and stuff like that as part of the negotiation, because the good gold price is great at the moment, and
Yep.
it all looks good, but on the downside, how do you protect yourself?
So again, all our transactions, and it's not a perfect science as you can appreciate, but we use, in terms of the commodity inputs, we use consensus. And the consensus right now is roughly over, for gold, just roughly over 2,200. So significantly stepped down from where we are today. I'd say that's the first barometer. We don't do transactions based on spot. It's just, again, we have no idea where this environment is going to go. Although I'm quite bullish and positive on gold, at least in the near term. And so we just have to continue to be disciplined and not chasing deals around the spot environment. Certainly the counterparties or the people that we're negotiating with would like to do those type of transactions, and if they get them from other parties, then so be it. We'll just sit on the sidelines. The other big thing, though, Matt, for us, that's absolutely sacrosanct, is security. So we need, in terms of guarantees, we need asset security. In some circumstances, we need parent guarantees, and depending where the asset is, and the ability to actually get as ironclad security as you possibly can. And with respect to some of these assets, we'll never do an unsecured deal. Like, I can guarantee you that. And so it's something that you asked about filters earlier. It's security around the cash flows to our shareholders is something sacrosanct, and we think through, and we'll never sacrifice that, even if the returns look really, really good.
Okay. Interesting. How do you assign value, or how do you record value across 185 royalties? Because we've talked about the good ones, right? And then you got a whole bunch which are, well, arguably aren't worth anything at the moment. So what do you think about that?
So we've got a team that one of the first things that I did do is, obviously we need to, as a management team, understand what our paper's worth, and then have the reflection as to what the market is ascribing to it. So we have a team that does all that valuation work. Obviously, it's easier. We've got 21 producing assets now. We've got two new ones that you mentioned, Tocantinzinho. We've got a full year of that asset this year. We've also got, as you mentioned, Cardinal Medini coming on in 2025 as well. Those assets are obviously easier to value. With respect to the other near-term development assets, again, what we do, we've got a very accomplished set of boots on the ground, 30-plus year geologists and mining engineers that really do the analysis around what these assets we believe are worth in this environment. And so there's a lot of work, obviously, that goes into it. I would say, though, that obviously we're focused on certainly the the producing assets, the development assets, the exploration assets. Like again, it's they're the integrity around our valuation around exploration assets is certainly less so, because then you're obviously trying to pick timelines, you're trying to pick construction frameworks, you're trying to pick certain things that again, with all those assets in the tail, it just wouldn't be a productive use for our time. But again, we certainly do look in and attempt to provide value for it, and it's a big part of what we think of our future value is, because if you look at where, for example, Franco was a number of years ago, we're effectively at that same point in terms of maturation of assets. There's a lot of stuff that's out there that in this commodity environment in particular could accelerate it. So that NAV could move forward very, very quickly around financing, around, again, governments are saying all the right things about permitting acceleration. All those sort of things could be very, very consequential to our portfolio. But right now we've got, in terms of our overall assets and reflecting of our NAV, only about just under 60% of our NAV is reflected in producing assets. And so as that matures and the assets come in, we'll obviously get better visibility. We think we'll get better valuation for it. And that's exactly where Franco was some 15 years ago.
Okay, so there's no pressure on you guys, given your balance sheet, to offload anything. You'll sit and let those mature.
So it's a great question. We've had, and we continue to have conversations about either trading assets with other companies. Again, it's very hard to get alignment on valuation. But we also do have some assets that don't necessarily fit our brand or portfolio. And I'll just mention one. We have a very high quality lithium asset in our portfolio. And so, as I said, we're precious metals. First of all, we're obviously focused on making sure we're providing appropriate cash flow for shareholders. We're not commodity agnostic, because we do like precious metals. 93% of our cash flow from 2024 comes from precious. So it's something that we will continue to do. But if we got, for example, inbounds around a lithium asset, it's called Corvette, in our portfolio in James Bay, Quebec, which we had a couple of years ago, we certainly would be open to having conversations and dialogue about, as I kind of refer to it, we just move the NAV forward. Because if we can realize value on an asset that's not our core commodity to shareholders today, we think that makes a tremendous amount of sense. But it's very, very, again, these are, in terms of the options, again, I think it would be very challenged just for us to get, first of all, what we think the appropriate value is. And secondly, as I like to say, we need significant schmuck insurance, because you definitely don't want to be in a situation where you've sold an asset and 10 years from now it turns to be another Detour Lake or Malartic. And so, to quote the very notable Christian Horner, who I think is the racing principal of F1, I love his quote, and he said, in their space, and it would say it's the same royalty and streaming space, there are winners and there are wankers, and you definitely don't want to be one of the wankers. And that, therefore, I think it would be very hard for us to be selling assets at the tail end of our optionality portfolio.
Well, let's see how he does this year. Hasn't started well. Right. Just onto the kind of the people side of things. Obviously, you felt it very important to change things at the board level. Can you talk to me about that kind of move from sort of entrepreneurial environment to corporate environment? And sometimes that can be a risk which doesn't pay off. So you obviously thought about it a lot. So give me a bit more detail on the why, and what do you think it's done for you, more importantly?
Yeah, so you're absolutely on point. The previous management team and some of the board were very entrepreneurial, and arguably that's what was required for the company. And look, we still have an association with them. For example, Sean Rusin, who is the founder of Osisko Gold Royalties, is running a company called Osisko Gold or Osisko Development. It's got a very, very prospective, fantastic asset in BC called Caribou. We own 24%, almost 25% of the equity. We've also got a 5% NSR there. And this was part of, again, its historic differentiating a royalty instrument where he bought a company called Barkerville. But again, where the company is now, we're the fourth or fifth largest royalty and streaming company by market cap, depending on the day. Again, we need to. We thought, and the board obviously agreed when they brought me in some 17 months ago, that the business is maturing. We don't necessarily. We still have a very much an entrepreneurial spirit within the company. We, as that's why I say, when we're looking at transactions, we're always looking at unique and innovative structures, but we're not going to go. We're not going to be regressing. We're not going to backslide and be buying some of these really, really cheap assets that are out there, because again, it's just a very different skill set. And because of that, and again, we've got a very understood corporate vision. There was obviously some reconstitution at the board, so almost 50% of the board has been reconstituted over the last 18 to 24 months. And putting the people in that actually have the skill set to understand. Again, it's a very, very, very difficult business, mining, and so augmenting our engineers with other engineers that are on our board now, and again, having a group that, and having a board that really fills out our skill set perspective, and again has very, very, very open ideas and concepts, and really just providing value around what we want to do in a more simplified business model go forward.
Right. Okay. Well, and for your, and it comes back to that kind of city, what investors get out of it. Now you've got there's a very different, I guess, profile of investor, because there's institutional investors and there are institutional investors. They will like different things. So, do you think that you delivered to your institutional investors, or are you rotating out some of those institutional investors and I guess upgrading them a bit? If that doesn't sound too rude.
Yeah, look, obviously we're very pleased in 2024 in that we got the attraction of some incredibly long-term sticky investors, such, for example, T. Rowe Price wasn't on our register, and now they're a top 5 shareholder before I joined. And we've got good concentration of some of the Canadian institutions that really didn't have a lot of exposure to our company, mainly because, again, they weren't necessarily an advocate or subscribed to the fact that buying mining assets, even if they're dirt cheap, was a way to move a royalty and streaming company go forward. And so groups like CIBC Asset Management, BMO Asset Management, they've moved up on our register significantly. Our major shareholder, or our number one shareholder, is a group here in Toronto called EdgePoint. We're very aligned with them. They're approximately 13% of our holding, 13. And so they're aligned with the vision that I laid out when I first got the role. And I would say in 2024, the best evidence for that, there has certainly been some rotation for sure, but the best evidence, at least from my seat, is we were the best performing royalty and streaming company out of, again, the top 6 companies out there last year. And we significantly outperformed our peers. And again, that's obviously our goal to go forward, but we've added a number of new investors that we think are very strong holders and long-term holders, and we look forward to having the conversations such as we're having with you around strategy and vision, because that's really what they want to understand and appreciate. It is a phenomenal business. There's no question about it.
Well, I think it answers the question with regards to how much heavy lifting was the gold price doing for you. But if you look at a comparison with your peers who are beneficiaries of that same element, you have outstripped them. So I guess there's a lot to like about the strategy, a lot to like about the portfolio, and obviously that kind of focus on that ROIC is really, really helpful. Look, Jason, I'm really kind of conscious of time here. A lot more to discuss, a lot more to ask, but as as an update after 3.5 years. Not a bad one. So appreciate your time today. And we will see you soon. And we can come and tell us about what we should look forward to in 25, 26.
Fantastic, Matt. Really appreciate your time today.